Have a great day. In this video, I'm gonna give an introduction to the subject business economics. Here we have a definition. This business economics is also termed as marginal economics. According to McNair and Merriam, marginal economics consists of the use of economic modes of thoughts to analyze business situation. Actually, this business economics is a field of applied economics that studies the financial, organizational, market related and environmental issues faced by corporations. Business economics encompasses subjects such as the concept of scarcity, product factor, distribution, and consumption. This business economics or managerial economics generally refers to the integration of economic theories with business practices. Also, economics provide various conceptual tools like demand, supply, price, competition, etc. They apply these tools to the management of the business. In this sense, business economics is also termed as applied economics. As next, here we have nature of business economics. First one, business economics is a science. What is science? It's simply a systematic body of knowledge which can establish a relationship between cause and effect. Further, mathematics, statistics, and econometrics are decision sciences. Business economics integrates these decision sciences with economic theories to arrive at strategies to help business to achieve their goals. Hence, it follows scientific method and also tests the validity of result. This is one aspect of the nature of business economics. Next one is it is based on microeconomics. A business manager is certainly more concerned about achieving the objective of his own organization. After all, this helps him to ensure profits and long-term survival of the firm. Business economics is more concerned with the decision-making situation of individual establishment. Therefore, it depends on the techniques of microeconomics. Then, it is an art. Business economics is an art as it requires the practical application of rules and principles of to achieve set objectives, and it is interdisciplinary. Business economics incorporates tools from many other disciplines like mathematics, statistics, accounting, marketing, and so on. Therefore, it is an interdisciplinary in nature. And this business economics is normative in nature. It offers suggestion for the application of economic principle while forming policies, making decisions, and planning for the future. Next, pragmatic in approach. Microeconomics is purely theoretical and analyzes economic occurrence under unrealistic assumption. On the other hand, business economics is pragmatic in its approach. It tries to solve the problem which the firm face in its real world. This business economics primarily uses the theory of markets and private enterprises. It uses the theory of the firm and resource allocation in a private enterprise economy. And finally, it incorporates elements of macro analysis. Even though all business focuses on their profitability and survival, a firm cannot operate in vacuum. The external environment of the economy, like income and employment levels in the economy, tax policies, and so on, affect the firm. All these external factors are component of macroeconomy. Therefore, a business manager has to take all such factors into consideration which may influence his business environment. So, these are all the nature of business economics. Next, we are going to see is scope of business economics. This scope is segregated into two types: microeconomics apply to operational issues and macroeconomics apply to environmental issues. Let's see it in detail. As the name says, internal or operational issues or issues that arises within a firm and or within the control of the management. First one under this microeconomics is analyzing demand and forecasting. Analyzing demand is all about understanding buyer behavior. It studies the preference of customer along with the effects of changes in the determinants of demand. Also, these determinants include the price of goods, consumer income, taste, preference, and so on. Forecasting demand is a technique used to predict the future demand for a good and services. Further, this prediction is based on the past behavior of factor which affect the demand. Secondly, production and cost analysis. By production analysis, the firm can choose the appropriate technology offering a technically efficient way of producing the output. Cost analysis, on the other hand, enable the firm to identify the behavior of cost when factors like output, time period, and the size of plant change. By using both this analysis, a firm can maximize profit by producing optimum output at least possible cost. Next is inventory management. Firm can use certain rules to reduce cost associated with maintaining inventories in the form of raw material, work in progress, and finished goods. So it is important to understand that the inventory policies affect the profitability of a firm. Next one is market structure and pricing policies. Any firm needs to know about the nature and extent of competition in the market. A thorough analysis of the market structure provides this information. Price theory, on the other hand, helps the firm in understanding how prices are determined under different kinds of market conditions. Also, it assists the firm in creating pricing policies. Then, resource allocation. Business economics uses advanced tools like linear programming to create the best course of action for an optimal utilization of available resources. And next we have theory of capital and investment decision. Among other decisions, a firm must carefully evaluate its investment decision and allocate its capital sensibly. Various theories pertaining to capital and investment offer scientific criteria for choosing investment projects. Further, these theories also help the firm in accessing the efficiency of capital. Business economics assists the decision making process when the firm needs to decide between competing uses of funds. And next, profit analysis. Profits depend on many factors like changing price, market condition, and so on. The profit theories help firm in measuring and managing profit under such uncertain condition. Further, they also help in planning future profits. Finally, risk and uncertainty analysis. Most businesses operates under a, under a certain amount of risk and uncertainty. Also, analyzing this risk and uncertainty can help firm in making efficient decision and formulating plans. Then, macroeconomics apply to environmental issues. External or environmental factors have a measurable impact on the performance of a business. The major macroeconomic factors are type of economic system, stages of business cycle, government economic policies, performance of the financial sector and capital market, and so on. The management of a firm has no control over this factor. Therefore, it is important that the firm fine-tunes its policies to minimize the adverse effect of their factors. Next, we are going to see some importance of this business economics. Business economics covers various important concepts such as demand and supply analysis, short run cost and long run cost, and law of diminishing marginal utility. This concept support manager in identifying and analyzing problems and finding solutions. It helps manager to identify and analyze various internal and external business factors and their impact on functioning of the organization. This business economics help manager in framing various policies such as pricing policy and cost policy on the basis of economic study and findings. By studying various economic variables such as cost production and business capital, organization can predict the future. Business economics help in establishing relationship between different economic factors such as income, profit, losses, and market structure. This helps in guiding manager in effective decision making and running the organization. I hope now you'll get some idea about the term business economics. Thank you.